Welcome back to the deep dive. We are doing something a little different today. Usually we take a broad topic and sort of narrow it down, but today we are starting microscopic, really, and expanding out.
Right.
We're looking at a single digital document. It's a PDF, specifically the Statement of Unaudited Financial Results for Abbott India Limited.
It's a classic quarterly report. Walls of numbers, tiny font, signed by the auditors, Walker, Chandiak & Co. Most people would look at this and immediately fall asleep.
Totally.
But if you actually read the rows, it's not just a spreadsheet, it's a narrative.
Exactly. And the date here really matters. It is February 2026, and we're looking at the health of this massive pharmaceutical giant for the quarter that just ended on December 31st, 2025. This is fresh data.
Very fresh.
And the reason I wanted to dive into this specific sheet is that I was looking at it earlier, and there is a contradiction in here that frankly doesn't make sense to me.
I think I know exactly which one you're talking about. You're looking at the difference between how much stuff they sold and, well, how much money they actually kept.
Right. It completely breaks that mental model of business goes up, everyone is happy. But before we get to the twist, we have to look at the top line, the revenue from operations.
Okay.
I'm looking at the column for the quarter ending December 31st, 2025. The number is 1,724.04 crores.
Which is a massive number, objectively. But in the context of Abbott India, how does that land for you?
Well, that's the thing. It feels light. I looked at the column right next to it, the previous quarter ending in September 2025, and they were at 1,757 crores.
So they're down from 3 months ago.
They are. But more importantly, I looked at the same quarter last year, December 2024. Back then, they pulled in 1,814.28 crores.
And that is the headline right there. Year over year, the raw demand for their products has shrunk by about 90 crores.
That's roughly a 5% drop. I mean, in the tech world, if you drop 5%, people start jumping out of windows. In pharma, maybe it's different, but it still signals the engine is slowing down, doesn't it?
It does. If I'm a shareholder looking at this, my first instinct is to worry that the market is shrinking.
Yeah.
When the top line contracts, it usually means one of three things. One, the market itself is down.
Yeah.
People just aren't getting sick as much, which is bad for business but good for humanity.
Right.
Two, competitors are eating your lunch. Or three, you've consciously decided to stop selling something that wasn't making money anyway.
So it could be strategic retreat rather than a defeat.
It's possible. But standing alone, that number 1,724 crores is a red flag. You rarely want to see a blue chip company shrinking its footprint year over year.
It puts immense pressure on everything else in the statement.
Absolutely. If less money is coming in, you have to be perfect with how you handle it.
Well, they do have a bit of a cushion. I noticed the next line down, other income. It's sitting at roughly 69.76 crores. That seems pretty high for other.
It does, doesn't it?
What exactly is Abbott doing on the side? Investing in real estate?
No, nothing that adventurous. Abbott India is a cash-rich machine. They have significant reserves just sitting in the bank.
Okay.
Other income for a company like this is almost always interest on deposits, returns on mutual funds, maybe a dividend. Think of it as the interest you earn on your savings account, just, multiplied by 1 billion.
Must be a nice savings account.
It is. And it acts as a shock absorber. When your sales operations have a bad quarter and drop by 90 crores, having a treasury department that hands you 70 crores in interest really helps smooth things over.
It brings the total income to about 1,793.80 crores.
Yep.
Okay, so the bank account is saving the day somewhat, but I don't want to let them off the hook for that sales drop. If we move down to the expenses, this is where the real identity of the company shows up, and this is where I got stuck.
You're looking at the breakdown of what they spent money on.
Yeah. I always picture Abbott as this, giant manufacturer, huge factories, guys in hazmat suits, mixing chemicals in giant vats.
Right.
But the numbers don't back that up. Look at row 2A and row 2B.
Cost of materials consumed versus purchases of stock and trade.
Exactly. Cost of materials consumed, which I assume is the raw ingredients to make drugs, is 147.31 crores. But purchases of stock and trade is 752.58 crores.
It is a staggering difference, isn't it?
It's a 5-to-1 ratio. They're spending 5 times more on buying finished stuff than they are on making stuff. So Are they even a manufacturer, or are they just a glorified grocery store for medicine?
That is the grocery store versus the farm analogy, and it's
Hmm.
perfect here. The farm, the manufacturer, buys seeds and fertilizer. That's their cost of materials. They grow the crop.
Takes time, capital, land.
A grocery store buys the finished tomato from the farmer and sells it to you. That is stock in trade.
So Abbott India, based on this ledger, is acting way more like the grocery store.
Exactly. They are a trader. They are likely importing finished drugs from their global parent company or buying them from third-party manufacturers and then using their branded distribution network to sell them.
Does that worry you? I mean, if you are just a middleman, don't you lose control? If the farm raises prices, the grocery store gets squeezed?
That is the risk. You lose control over the supply chain cost. But flip it around. Think about the agility.
Hmm.
If you own the farm and a drought hits, or in business terms, demand drops, you still have to pay for the land, the tractors, the labor. You have high fixed costs.
Okay.
But if you're the grocery store and demand drops, you just order fewer tomatoes next week.
You stop buying the stock and trade.
Precisely. And that flexibility is the secret weapon in this specific document. Remember how we panicked about revenue dropping?
Just sales went down.
Well, because they rely so heavily on stock and trade, look at what happened to their expenses compared to last year.
Okay, let me scroll down. Total expenses for this quarter are 1,284.82 crores. Last year, same quarter, it was 1,381.14 crores.
They cut nearly 100 crores out of their cost structure.
That is a massive cut. So even though they sold less, they spent way less.
And that is very hard to do if you are a heavy manufacturer with unionized factory workers and idle machinery. But because Abbott acts as a distributor, they can throttle their costs much faster. They're lighter on their feet.
There is one line item here that they can't throttle, though, and it's huge. Employee benefits expense. It's sitting at 196.07 crores.
Almost 200 crores in 3 months. That is the human element.
That seems like a lot for a company that is essentially just moving boxes of stock and trade.
But they aren't just moving boxes. They are moving ideas. In the pharmaceutical world, especially in India, you don't sell by putting a billboard up.
Right.
You sell by having a medical representative and MR walk into a doctor's office, sit down, and explain why this specific antibiotic is better than the generic one. That takes an army of smart, well-paid people.
So that 200 crores is the sales force.
It's the sales force, the regulatory team, the compliance officers. That is the moat. You and I could start a pharma trading company tomorrow, but we couldn't replicate that army of people visiting doctors. That is where Abbott's real power lies, not in the factories.
I also noticed a weird positive number in the expenses, changes in inventories. It's positive 8.92 crores? How does an expense end up being a positive number?
This trips people up all the time. In this accounting format, think of it as a balancing act. A positive number here generally means they reduced their inventory levels. They sold a bit more than they brought in or made this quarter.
So they are running lean. They aren't sitting on a mountain of unsold pills.
Exactly. It's a sign of efficiency. They are clearing the shelves.
Okay, so let's put this puzzle together. We have revenue that is down. We have a business model that is heavy on trading, which lets them be flexible, and a high cost of employees. So income minus expenses gives us profit before tax.
Row 3, what's the number?
508.98 crores.
That is a very healthy number. I mean, just to do a quick mental check. 500 crores profit on roughly 1,700 crores revenue. That's nearly a 30% margin before tax.
That is absurdly high. Retail stores operate on what, like 4%? Manufacturing is usually 10 to 15. How are they hitting nearly 30?
It's the power of the brand and that premium product mix. They aren't selling generic paracetamol for pennies. They're selling specialized treatments where they have pricing power.
And because they manage those expenses we talked about so tightly?
They keep a huge chunk of every rupee they earn.
But then the government takes a bite. Total tax expenses is 133.02 crores.
Which is about 26%. That's the standard corporate tax rate. Nothing really to see there.
And that brings us to the net profit, the bottom line, row 5. It is 375.96 crores.
Now compare that to last year. This is the moment of truth.
Okay, last year, December 2024, profit was 360.78 crores. So, wait.
You see it.
Revenue dropped from 1,814 down to 1,724, but profit rose from 360 to 375. They sold significantly less product, but they made significantly more money.
That is the aha moment. That is why you cannot just read the headlines. If you saw a headline, Abbott sales drop, you'd panic. But the reality is, Abbott efficiency spikes.
It's impressive, but is it sustainable? It feels like a magic trick. You can only cut costs for so long, right? You can't shrink your way to greatness forever.
You are absolutely right. This is a great defensive maneuver for a tough quarter. They protected the bottom line by tightening the belt. But you cannot do this for 5 years in a row.
Right.
Eventually, you need the top line to grow again. If revenue keeps shrinking, eventually the profit will follow, no matter how efficient you are.
So, is Abbott in trouble? Is this the start of a long decline?
To answer that, you have to hit the zoom out button. We've been obsessing over 3 months. Look at the column for 9 months ended December 31st, 2025.
The year-to-date column. Okay, let's look at the cumulative revenue. It's 5,219.54 crores.
And compare that to the previous year's 9 months.
Previous year was 4,834.56 crores.
Oh, what do you see?
It's up. It's up by almost 400 crores.
Exactly. So, is the company shrinking?
No. On a 9-month basis, they are growing quite healthily. It looks like Q3 was just a speed bump.
Precisely. It could be seasonal. It could be a specific regulatory delay on a product. It could be 1,000 minor things. But the long-term trend, the 9-month trend, is solid growth.
And the profit for the 9 months?
Row 5 again.
1,157.09 crores. Last year was 1,047.480 crores. So they are roughly 110 crores richer this year than last year.
So the narrative shifts completely. It goes from company in decline saves itself with cost cuts to growth machine has a slow quarter but maintains discipline.
That is a huge difference in perspective. If I just looked at the Q3 column, I'd sell the stock. If I look at the 9-month column, I'd probably hold or buy.
And that is why these reports are dangerous if you don't know how to read the context. They're just snapshots. You have to watch the whole movie.
Let's talk about what this means for the person who actually owns the stock. The earnings per share, or EPS. It's all the way at the bottom.
This is the number that ultimately drives the stock price. It answers the question. For every share I hold, how much profit did the company generate?
For this quarter, it's 176.92 rupees.
And that is not annualized. That is just what your share earned in these 3 months.
Last year, it was 169.78 rupees. So my share is working harder for me, even though the company sold less. That's kind of reassuring.
It is. It proves that management is aligned with shareholders. They aren't just chasing sales at any cost. They are focused on value.
And the 9-month EPS?
544.51 rupees versus 492.89 rupees.
That is a jump of over 50 rupees per share. That is massive value creation in less than a year.
It is. And it brings us back to that grocery store model. That model is what allowed them to deliver this EPS. If they were stuck with high fixed manufacturing costs during this Q3 slowdown, that EPS number would have likely dropped.
They would have had to eat the costs of the idle factory.
Instead, they passed the savings on to the shareholder.
But let's go back to that risk you mentioned, the supply chain. If they're buying so much stock in trade, aren't they vulnerable? What if the farmer decides to raise prices next year?
That is the eternal tension in this business model. Abbott India is a subsidiary of a global giant. A lot of that stock and trade is likely coming from the parent company.
Okay.
So the risk isn't that the vendor disappears, but transfer pricing, the price at which they buy from their parent, can change.
So they are safe because they are in the family, but they are dependent because they don't own the kitchen.
Correct. They are the front of house. They own the menu, the waiters, and the customer relationship. But someone else is cooking the food.
It's a fascinating way to look at a manufacturer. It really forces you to redefine what a company actually is. Is it the thing that makes the product or the thing that connects the product to the customer?
In the modern economy, value has shifted to the connection. The manufacturing is often a commodity. The brand, the distribution, the trust. That is where the 30% margin lives.
So to wrap this up, we started with a scary revenue drop. We found out it was cushioned by a huge pile of cash-earning interest. And we discovered that this company is basically a high-tech trader.
Buying 5 times more than it makes.
And that model allowed them to cut costs so aggressively that they made record profits even while shrinking. And the final verdict from the 9-month view is that the growth story is still intact.
It's a masterclass in reading between the lines. It really is. It shows that growth isn't a straight line. Sometimes you have to crouch to jump. Q3 was a crouch.
I love that image. Q3 was a crouch. So here's the thought I want to leave everyone with today. We often judge companies by how big their factories are. But Abbott India is showing us that agility might be more valuable than assets.
In a volatile world, the ability to pivot is worth more than the ability to produce.
So ask yourself, in your own work or your own portfolio, are you the farm that is stuck with the harvest, or are you the grocery store that can change the display overnight?
A provocative question.
Thanks for diving up with us today. We'll see you on the next one. Welcome back to the deep dive. We are doing something a little different today.
A bit of an experiment.
Yeah, exactly. Usually, we have a stack of articles, maybe a book, research papers. Today, our source material is a single image, just one.
It is a departure, isn't it? But, sometimes a single image can hold more information than a 50-page report.
That's what I'm thinking. It's a snapshot in time. Specifically, we're looking at a financial artifact, a candlestick stock chart for Abbott India Limited.
Abbott India on the National Stock Exchange.
Right. And to set the scene for everyone, today is Thursday, February 12th, 2026. This data runs right up to this afternoon, covering the last few months.
All the way from late October 2025.
And this isn't just about one company, is it? It's really about learning to read the language of the markets.
It's a language all its own. We think of reading as text, but a chart is a visual representation of human psychology.
Fear, greed, all of that.
Exactly. Fear, greed, hesitation, decision-making, all captured in these little bars.
I love that. It's like an X-ray of the market's brain.
Yeah.
Now, to the untrained eye, and I'll put myself in that category for a moment, this looks like a jumble.
Mm-hmm.
We've got red and green blocks, jagged lines, a few, snake-like lines curving through it. But our mission today is to decode this.
To go from pretty colors to actionable information.
Precisely. We're going to strip away the noise. We've got 4 distinct layers of data here.
The price action, the moving averages, and Bollinger Bands, then the RSI, and finally volume at the bottom.
And by the time we're done, we should see a narrative, right? A story of a battle between buyers and sellers.
That's the goal.
Okay, let's start with the headline numbers for today, February 12th. Abbott India opened at 27,135.
Okay.
It hit a high of, well, exactly the same, 27,135. But then it dropped to a low of 26,550 before closing at 26,700. Just hearing that, it sounds like a rough day.
It was a day where optimism was effectively non-existent.
That sounds harsh. Why do you say that?
Well, look at the open and the high. They are identical. In technical analysis, that is a very specific, very bearish signal. It means from the exact second the opening bell rang, sellers took control.
So there was zero upward pressure?
None. Not even for a second.
Mm.
No one stepped in to bid the price up even a single rupee. They just drove it straight down.
So the bell rings and bam,
Yes, sir.
immediate selling.
Exactly. And while it did recover a little bit from that absolute bottom, closing at 26,700 tells you who's in charge.
The sellers.
The bears are driving the bus. They are dictating the terms.
Okay, let's unpack this whole visual landscape, starting with the top pane. If I look at the left side, back in late October 2025, the price was way up there.
Near the 29,920 mark.
Yeah, looking at the y-axis. And now we're all the way down at 26,700. Just visually, this is a slide.
It is a classic textbook downtrend. If you were to just draw a line connecting the peaks, it's pointing sharply down and to the right, a gradient of decline.
And you mentioned the colors, the
Yeah.
red and green bars, the candles.
Right, let's just make sure everyone's on the same page.
Good idea. So green means the price closed higher than it opened. A good day for buyers.
And red means it closed lower. A win for the sellers.
And looking at the right side of this chart, so January and February of this year, it is overwhelmingly red.
That is the psychology manifesting visually. Since the new year began, it's just been consistent disappointment for anyone holding the stock.
But I want to go back to the volatility of just today. You mentioned the struggle to find a floor.
Exactly. That gap between 26,550 and the close at 26,700, that's a fight. But the real drama, the thing that set all this in motion, happened earlier. Look back at early December.
Oh, wow. Yeah. It looks like a waterfall.
That is the perfect word for it.
I mean, it really does. The stock just fell off a cliff.
The candles just cascaded down. Up until late November, things were kind of choppy, moving sideways.
Lulling everyone into a false sense of security.
You got it. And then, early December, the sentiment shifted violently from wait and see to get me out right now. That waterfall broke the back of the trend.
So we're essentially living in the aftermath of that drop.
That's a great way to put it. The market has a memory. Investors are bruised from that.
Okay, let's move on to the second layer. I see these snake-like lines winding through the candles. There's a smooth red one and 2 green ones that sort of envelop the price.
Right. This brings us to resistance and constraints. Let's start with that smooth red line. That's a moving average.
Oh.
Think of it as the average consensus of value over time. It smooths out all the daily noise.
And it shows you the true direction of the tide.
And right now, that tide is going out rapidly.
Mm-hmm.
But more importantly, look at how the price interacts with that red line.
It seems to be acting like a ceiling.
Exactly.
Yeah.
Yeah, every time the candles try to poke their heads up,
They hit that red line and get knocked straight back down.
that is dynamic resistance. Look at late December, early January. You see those few green candles? That was an attempt to rally.
Right. Buyers tried to come in.
They probably thought, okay, the worst is over, let's buy the dip.
Mm-hmm.
But what happened the moment the price touched that red line?
It just bounced right back down. It's like an electric fence.
And that tells a professional trader that the long-term trend is stronger than any short-term optimism. The trend is literally keeping the price suppressed.
So until it can break above that line and stay there, any rally is just a blip.
A dead cat bounce, as they call it.
A dead cat bounce. That's a vivid image.
It's morbid, but effective. Just because a stock jumps for a day doesn't mean the downtrend is over.
Okay, so the red line is the ceiling. What about these green lines, the guardrails? One above and one below.
Those are the Bollinger Bands. Now, without getting too deep in the math, they basically measure volatility.
Okay.
When the bands are far apart, the market is wild. When they pinch together, it's quiet. Notice what happened during that December waterfall.
The bands blew wide open. The tunnel got huge.
Right, because volatility and fear spiked. But look at them now. They're parallel, but they're pointing down. And here's the critical detail. Look where the candles are sitting relative to those green lines.
They're hugging the bottom one. They're practically walking along that lower green line.
We call that walking the band. And it is not a good sign if you're holding this stock. It implies strong, sustained, downward momentum.
Wait, I thought if it hit the bottom band, it was supposed to bounce back up, like a rubber band stretching to its limit?
That is a very, very common misconception. In a sideways market, yes, you buy the bottom and sell at the top. But in a strong downtrend like this,
It's different.
hitting the bottom band doesn't mean cheap. It means weak. The price isn't just falling. It's pressing against the lower statistical boundary of where it should be.
So it's not a rubber band snapping back. It's a heavy weight dragging the band down with it.
Exactly. A perfect analogy. It just keeps pushing the boundary lower.
That's a crucial distinction. Okay, so this feels claustrophobic. The price is falling, it's under an electric fence, and it's glued to the floor. Let's look under the hood. The middle pane, RSI 14. What's this white line telling us?
RSI is the relative strength index. Think of it like a speedometer for the stock's momentum. It runs from 0 to 100.
And looking at the scale here, it's sort of hovering in the lower third, bouncing between 30 and 50.
Correct. Conventionally, below 30 is oversold, dropped too fast, and above 70 is overbought.
But this isn't really doing either. It's just hanging out low.
It's sluggish. That's the worry. It's not crashing right now. A crash on the RSI would be a sharp spike down. But look at mid-December. The RSI dipped hard with the price, and it just hasn't been able to recover since.
It's like the stock is trying to run uphill, but it's completely out of breath.
That's it. It can't catch a second wind. And here's a key concept, divergence. Traders look for that.
This divergence.
It's when the price makes a new low, but the RSI starts to go up. It signals that selling pressure is fading, even if the price hasn't turned yet.
So do we see any of that here? Any hidden strength?
No, we do not.
Yeah.
The price is trending weekly, and the RSI is trending weekly. They're in sync.
So the momentum is just confirming the price action. There's no glimmer of hope there yet.
We're not oversold enough to guarantee a bounce, but we're definitely in the danger zone.
Okay, so the engine is sputtering. Now let's look at the fuel tank. The very bottom pane. Volume.
Volume. This is the truth serum of the market. I cannot stress this enough.
Why is it so important?
Because price can move on thin air, but volume tells you how many shares actually changed hands. It's the conviction behind a move.
And I'm seeing a couple of massive spikes here. There's a huge green bar way back in early November.
Yes. That was a huge surge in buying interest. Someone big in institution maybe stepped in and bought a lot of stock.
But if you look at the price chart right above it,
Right.
that didn't work out so well for them. The momentum died almost immediately.
Precisely. That is a failed rally. High volume on a green candle that leads to nothing is a massive warning sign.
Why?
It means the sellers just absorbed all that buying power and kept pushing down. Think about the psychology. Those big buyers from November,
They're trapped. They're losing money.
they're underwater. And now they might be selling every time the price ticks up just to cut their losses. That creates more selling pressure.
And I see another green spike around December 19th.
Right. And that lines up with that brief attempt to rally we talked about, the one that hit the red line and failed.
So buyers tried again with conviction and got rejected again.
Exactly. But what about now? Look at late January through today. These volume bars are tiny, They're flat.
Like a freshly mowed lawn.
This is fascinating. This signals apathy.
Apathy. Is that worse than panic?
In some ways, yes. If we saw huge red volume bars, it would mean panic selling. That often marks a bottom, a capitulation.
Because everyone who wants to sell has sold.
Exactly. But we aren't seeing that. And we aren't seeing any green spikes either. No one is buying. The stock is just drifting down on low volume.
It's a slow bleed.
It's a slow bleed. It implies the price isn't cheap enough to attract buyers, but the holders aren't scared enough to just dump everything. It's just drifting.
So if we zoom out and put this all together, this Nuvama snapshot, how do you synthesize this? How do you connect the dots for the listener?
Imagine you're a detective. We have 4 pieces of hard evidence. Evidence A, the price. It's making lower lows. The structure is broken. Evidence B, the trend. It's trapped below that red moving average ceiling.
Right, the electric fence.
Evidence C, momentum.
Yeah.
It's riding the lower Bollinger Band, a position of weakness. And evidence D, the fuel. Volume is drying up.
When you stack it up like that, the narrative is crystal clear.
The narrative is that the bears are in control, but they aren't even working that hard. They're just leaning on the price, and it's giving way. The market is just waiting.
Waiting for a catalyst.
Yes. Because right now, there is no technical reason for this price to go up. To turn this ship around, you'd need a breakout above that red line with a massive spike in green volume. Proof that big money is back.
Until then, the path of least resistance is down.
That's what the chart says.
It's really incredible how much story is packed into this one image. We started with what looked like random geometry, and now it feels like we've watched a movie of the last 4 months.
And that's the power of technical analysis. It removes your own emotion from the equation and just shows you the collective emotion of everyone else.
It's not a crystal ball.
Not at all. It's about reading the present accurately. Most people trade what they hope will happen. The chart shows you what is happening.
And for you listening, think about what this represents. That low of 26,550, that's not just a number, that's real money, real decisions people made today.
Exactly. Every tick is a transaction between 2 people who completely disagree on value. One thinks it's going up, one thinks it's going down.
Only one can be right. Learning to read these layers, trend, momentum, volume, it turns a chaotic picture into a map. It tells you where the landmines are.
Absolutely. It changes the question from what do I hope happens to what is the chart telling me is happening. And right now, this chart is screaming caution.
Before we wrap up, I want to leave everyone with a final thought, sort of a devil's advocate position.
Yeah.
We looked at the RSI, and it's low. We saw the price hugging the bottom of the Bollinger Band. Textbook analysis often says these conditions mean a snapback or reversal is due, just from exhaustion.
That is the classic contrarian view. When everyone is bearish, when the chart looks terrible, that's often when a bottom is close. The market loves to fool the majority.
Exactly. But here's the catch, and this is the thought I want to leave you with. With volume so low, who is going to start the fire? A reversal needs fuel.
A spark.
Right. So looking at Abbott India at 26,700, is this a massive discount opportunity for a brave soul, a bargain? Or is this what traders call a falling knife? Something that looks cheap but is just waiting to cut the next person who tries to catch it?
That is the million-dollar question. Or in this case, the 26,000 rupee question. Without volume, that knife can keep falling for a long, long time.
Indeed it can, and that is where the risk and the reward live. Take a look at the charts, do your own digging, and see what you find. Thanks for diving deep with us today.
My pleasure. We'll talk soon.